At dawn, a pump station hums behind chain link in southwest Austin. Water flows through buried pipes. Grackles cluster on the fence. The reservoir catches first light. 25 miles away, in a downtown office, sits a loan file 3 inches thick. 4 project notes. 1 personal guarantee. $80 million advanced. Cross-default language binding every borrowed dollar to every other borrowed dollar. The water runs because pipes were financed. The pipes were financed because a bank made promises. The bank failed while developers still owed. A story of Sunbelt growth ambition. A story of debt instruments that outlived the institutions creating them. A story of public infrastructure enabling private profit until the credit cycle snapped. Was Circle C Ranch a brilliant development bet strangled by a once-in-generation banking crisis? Or was it a debt machine that finally met its match? The ranch became a balance sheet. Someone would pay. Chapter 1. When the ranch becomes currency. The pump station runs because someone bought land 40 years before pipes mattered. In 1945, Mary Pauline Brooks Blanton, known as Polly, purchased several thousand acres in southwest Travis County. She named it Circle C Ranch. The land rolled across hills cut by Slaughter Creek, positioned where the creek runs toward Barton Springs and the Edwards Aquifer recharge zone beneath. Polly raised registered Hereford cattle. The animals grazed. The operation functioned quietly. Cattle required feeding, veterinary attention, breeding records maintained with precision. Someone repaired fences. Someone managed water sources during dry summers. Someone handled livestock during sorting and shipment. The historical record preserves Polly Blanton's name and the ranch's name. It does not preserve the names of the men who did the daily work. The ranch hands, the foremen, the people whose labor made operations possible. This gap is not unique to Circle C. It is the standard arrangement. Owners are remembered. Workers are not. The land sat in a location that would eventually carry political weight far beyond ranch boundaries. Southwest Travis County, the Edwards Aquifer recharge zone threading beneath the soil, Slaughter Creek running toward Barton Springs, the limestone-fed swimming pool that would become the symbolic heart of Austin's environmental identity. In 1945, these geographic facts were simply physical reality. By the 1980s, they would become weapons in battles over growth, water quality, and who decides the future of a rapidly expanding city. Polly Blanton died. The ranch changed hands. By the early 1980s, development interests began circling. Austin was growing fast. The city needed suburban land. Developers needed projects that could absorb large capital amounts and generate returns justifying risk. The ranch, now several thousand acres of undeveloped land positioned along a growth corridor, represented exactly what ambitious builders chase. The pitch was a master-planned community, not just a subdivision carved from raw land, but an entire self-contained environment, residential neighborhoods, shopping centers, parks, golf courses, schools, all the infrastructure making suburban life function. Roads must be built. Water and wastewater systems must be installed. Electrical lines must be buried. Storm drainage must be engineered. Each element requires capital. Master-planned communities are not built with pocket money. They are built with loans measured in tens of millions of dollars, structured with guarantees and cross-collateralization that bind entire projects into single financial organisms. The marketing materials showed tree-lined streets and families enjoying amenities. The brochures described hill country living within reach of downtown Austin. Reality would involve different work entirely. Where Polly Blanton's ranch required men who understood cattle and grass, the development project would require civil engineering crews, concrete pourers, pipe fitters, heavy equipment operators, electricians, inspectors. The small army of skilled trades that turns surveyed dirt into functioning suburbs. Two completely different universes of labor. Two completely different relationships to land. The people building the subdivision would never meet anyone who worked the ranch. The transformation was described as honoring the ranch's legacy. The name would be preserved. Circle C Ranch would live on, reconceived as a place where families could build equity and enjoy recreational amenities in a carefully planned environment. The ranch legacy was being used as marketing material, a comforting story smoothing the conversion of working land into financial instrument. The name Circle C would appear on entrance signs and homeowners association documents. The ranch itself, the actual working operation, the specific arrangement of human effort and animal husbandry, would be erased as completely as if it never existed. By the time ground was broken, most people hearing the name Circle C Ranch would assume it had always been a neighborhood. The cattle would be gone. The ranch hands would be gone. The owners would be replaced by developers. And beneath it all, a new infrastructure would be taking shape. Not just pipes and roads, but promissory notes, personal guarantees, and legal structures designed to extract value from the gap between what land costs empty and what it's worth when families live there. Within months, the deal behind the deal would be structured. Chapter 2. The real construction material. The ranch had become real estate. Real estate needed money. In 1985, Circle C Development Corporation executed loan agreements with Gibraltar Savings Association, a Texas thrift institution riding the wave of deregulated lending that characterized the decade. The principals were Gary L. Bradley and James D. Gressett. Their names would become inseparable from both the project's ambitions and its unraveling. Bradley worked from an office in a distinctive building at 1111 West 11th Street in Austin, a turreted structure locals called the Castle. The building's architecture suggested permanence and established power. Bradley's role in Circle C would make him both a symbol of entrepreneurial vision and a lightning rod for accusations about how that vision was financed. Gressett operated as partner and co-guarantor. A third figure, Mitchell Sharp, appears in some reporting as an early partner who exited through a buyout arrangement, though specifics remain contested. What mattered was not these men's biographies, but their legal relationship to the capital being deployed. They were personally liable for debts being created. The project was framed as a Sunbelt growth bet. Austin in the mid-1980s was expanding rapidly, driven by technology sector growth, university expansion, and migration from colder climates and expensive coastal markets. City politics wrestled with tensions between development interests pushing for growth and environmental advocates warning about water quality and loss of hill country character. Circle C sat directly in the middle, positioned over sensitive recharge zones, large enough to impact regional infrastructure, ambitious enough to require capital that transforms local disputes into high-stakes financial battles. The true construction material was promissory notes, legal instruments where one party promises to pay a specified sum to another party under defined terms. The borrower signs. The lender holds it as proof of debt. Default triggers legal remedies to recover outstanding balance. Promissory notes are routine financial instruments. What made them significant was how they were structured and what happened when multiple notes bound together through cross-reference clauses. A guarantee extends liability beyond the original borrower. When someone guarantees debt, they promise to pay if the primary borrower cannot. For the person signing, it means personal exposure to debts that might vastly exceed individual wealth. In development finance, guarantees ensure lenders can pursue recovery even when projects fail. The structure being assembled was presented as disciplined development finance, leverage necessary to build large-scale projects in competitive markets. Lenders don't advance tens of millions without security. Borrowers don't get favorable terms without assuming meaningful risk. The system functions when projects succeed. To builders operating in Texas business culture, this represented exactly what that culture celebrated: ambitious individuals taking substantial personal risk to create something valuable. To skeptics examining the same documents, the loan structure wasn't aggressive. It was engineered to maximize lender protection while concentrating risk on principles. Multiple notes binding together. Personal guarantees extending liability beyond project assets. Terms that would leave borrowers with few options if anything went wrong. The financing wasn't enabling growth. It was constructing a trap that would spring shut the moment economic conditions shifted. Same documents, different readings. The project moved forward. Ground was broken. Infrastructure work began. 4 project notes covering different phases. A personal note for $15 million. Personal guarantees from Bradley and Gressett, each covering 20% of project debt. Gibraltar Savings, advancing nearly $80 million into the project over time. Later reporting would describe total default magnitude reaching approximately $118 million when all obligations were tallied, though this figure encompasses claims that would be disputed in court. The numbers mattered more than the dirt. They mattered more than the water lines. Embedded in the loan documents was a clause that would determine everyone's fate. The tripwire was already installed. Chapter 3. The Public Machinery. While Bradley and Gressett signed promissory notes with Gibraltar, another financing mechanism was being constructed. This parallel system involved municipal bonds, special government districts, and a structure where taxpayers would guarantee the pipes and roads that private developers needed to make their subdivision profitable. The mechanism was a municipal utility district, a special-purpose government created to provide water, wastewater, and drainage services to areas outside existing city utility systems. The district operates with its own board of directors, initially appointed by developers and later elected by residents. It possesses powers that ordinary neighborhoods do not. The authority to issue bonds backed by property taxes, the ability to charge fees for services, legal standing to own and maintain infrastructure worth tens of millions of dollars. The arrangement follows a specific sequence. The developer constructs facilities, water lines, wastewater treatment plants, pump stations, reservoirs, using money borrowed from private lenders. Once constructed, facilities are conveyed to the district. The district issues bonds to reimburse the developer for construction costs. Bonds are repaid over time through property taxes and service fees charged to residents who buy homes. The developer gets immediate capital recovery. The district assumes long-term debt. Future homeowners inherit the obligation. Alongside the district structure, the City of Austin employed contract revenue bonds to finance major utility infrastructure. These bonds were backed by the city's promise to repay from revenues generated by water and wastewater fees. The arrangement allowed large-scale investment without immediately burdening the general tax base, but it created obligations spanning decades and required the utility system to generate sufficient revenue to cover debt service. On September 1, 1988, the Austin City Council met to consider items related to Circle C infrastructure financing. The agenda included authorization for a municipal utility district and approval of bond issuance. Council chambers filled with citizens interested in growth policy, environmental advocates concerned about aquifer impacts, and business representatives supporting development. Public comment periods allowed speakers to address council. The substantive negotiations had already occurred in executive sessions, closed-door meetings where council members discussed legal and financial details away from public observation. The minutes and accompanying packet list contractors handling various work aspects. J.C. Evans Construction Company appears in connection with reservoir and pump station construction. Other firms, Hayden Concrete, Triple Vive Construction, Robert Hurst Company, show up in bid tabulations and contract awards. These companies employed the equipment operators excavating trenches, pipe fitters connecting water lines, concrete workers pouring foundations, electricians wiring control systems. The men doing this work were not making development decisions. They were executing plans created by engineers and financed through structures they had no voice in designing. Initial bond authorization was set at $3.3 million to cover early-phase infrastructure. The framework included provisions for expansion. The district's eventual borrowing authority would reach $38 million, enough to fund major facilities including multiple reservoirs, several pump stations, miles of water transmission lines, and wastewater collection and treatment infrastructure necessary to serve thousands of homes. These were not temporary installations. They were permanent systems requiring maintenance, replacement, and eventual expansion for as long as the community existed. The arrangement was efficient public-private partnership. Developers provided upfront capital and expertise. The public sector provided bonding authority and long-term financing at favorable rates. Neither side could build a functioning subdivision alone. When it worked, everyone benefited. To those examining where risk ultimately settled, the developer borrowed from a private bank, built facilities, transferred ownership to a public entity, and got reimbursed through bond proceeds. If property sales proceeded as planned, the developer profited handsomely. Meanwhile, the municipal utility district, and by extension, residents and the city providing backup guarantees, assumed debt obligations lasting 20 to 30 years. The developer captured short-term gains. The public absorbed long-term risk. Both systems operated simultaneously. Private promissory notes from Gibraltar financed land acquisition and development planning. Public bonds financed infrastructure, making the land valuable. The two systems intersected but operated under completely different rules, one governed by private contract law and banking regulations, the other governed by municipal finance law and democratic accountability. Within months, the private structure would break. What happened then would reveal how intertwined they had become. Two systems, one fault line. Chapter 4. While the papers burned. While Bradley and Gressett negotiated with Gibraltar over missed payments and default notices, another machinery kept operating. City Council continued meeting. Municipal utility districts continued forming. Bonds continued being issued. Construction crews continued working. The public infrastructure system that would outlast the private financing drama was being assembled piece by piece, recorded in council minutes that few residents would ever read. On March 9, 1989, Austin City Council approved an ordinance amending the consent agreement for Circle C Municipal Utility Districts No. 1 and No. 4, the legal framework governing coordination on service provision and infrastructure standards. The amendments addressed technical details about which parcels could be developed and under what conditions. To anyone not immersed in municipal finance, the ordinance appeared routine. Each amendment represented negotiations between the developer, the city, and the utility districts about who would build what and who would pay. 9 months later, on December 14, 1989, the Council authorized Circle C Municipal Utility District No. 4 to issue bonds totaling approximately $3,300,000. The bonds would be repaid from water and wastewater fees. Council minutes show some members questioning whether the city was assuming too much risk. The work continued, concrete was poured, trenches were excavated, pipe was installed. On June 28, 1990, Council approved payment of $77,906.40 to J.C. Evans Construction Company for work on Circle C Municipal Utility District No. 3. The payment covered reservoir and pump station construction, critical infrastructure for a community that would eventually house thousands of families. The pump stations would operate continuously. The reservoirs would store treated water ready for delivery through distribution lines. These were permanent facilities requiring maintenance and eventual replacement for as long as homes existed at Circle C. J.C. Evans was not working alone. The contractor ecosystem included Hayden Concrete, Triple Vi Construction, and Robert Hurst Company. Firms that appeared repeatedly in bid tabulations and payment authorizations, documented in council packets, employed the equipment operators, pipe fitters, concrete finishers, and electricians who translated engineering plans into functioning infrastructure. The workers arrived at job sites each morning, operated machinery, managed materials, and executed tasks according to specifications they had no role in writing. Some firms operated under unusual ownership structures. Reports suggest at least one major excavation contractor functioned as an employee stock ownership plan. If accurate, workers technically owned shares in the company. This created different relationships between labor and capital than standard wage employment. Workers with ownership stakes might benefit from company profitability in ways hourly employees would not. But the structure did not give them decision-making power over which projects the company pursued. By April 25, 1991, the infrastructure investment had grown substantially. Council authorized Circle C Municipal Utility District No. 3 to issue contract revenue refunding bonds, Series 1991, in an amount not to exceed $38 million. Refunding bonds refinance existing debt, typically to achieve better interest rates or extend repayment terms. The authorization indicated that earlier financing had been replaced or restructured. The district's long-term debt obligations had expanded far beyond initial projections. $38 million in bonded debt for a single utility district serving one subdivision. Repayment would extend into the 2020s, binding residents not yet born when bonds were issued. To those watching infrastructure approvals, the public system was enabling needed housing. Austin was growing rapidly. The region required new residential capacity to accommodate population growth. Master-planned communities like Circle C provided that capacity at scale. Without public infrastructure financing, developers would struggle to build projects large enough to matter. The municipal utility district structure allowed construction to proceed even when private lenders became cautious. To those watching the parallel timelines, public balance sheets were absorbing private risk to keep a troubled project alive. Gibraltar had lent nearly $80 million to Bradley and Gressett. That private financing was collapsing. Yet the public infrastructure system continued advancing money, issuing bonds, and making payments to contractors. The city and utility districts were ensuring Circle C's physical build-out would continue regardless of whether developers could meet private obligations. Profit from eventual property sales would flow to private interests. Long-term debt would rest with public entities and future ratepayers. March 9th, 1989. December 14th, 1989. June 28th, 1990. April 25th, 1991. Each date marked another increment in public commitment to Circle C's infrastructure. $3,300,000, $77,906.40, $38 million. Each number represented obligations that would outlast the developers, the original lenders, and possibly the people who authorized them. The private lender was about to fail at the worst possible moment. Chapter 5. When the Lender Vanishes. The worst moment arrived on schedule. On December 27, 1988, federal regulators declared Gibraltar Savings Association insolvent. The Federal Savings and Loan Insurance Corporation, the agency managing failed thrift institutions during the savings and loan crisis, was appointed receiver. Gibraltar's operations ceased. Its assets became property of the receivership. The promissory notes it held, including Circle C loans to Bradley and Gresset, were no longer private contracts between borrower and functioning lender. They had become government inventory. The transfer happened overnight. On December 28, 1988, one day after Gibraltar's collapse, the receiver sold and endorsed many Gibraltar assets to a successor institution, First Gibraltar Bank, FSB. The transaction was structured as purchase and assumption. The successor bank purchased selected assets and assumed selected liabilities. Circle C's notes were included. Bradley and Gresset went to sleep owing money to Gibraltar Savings Association. They woke up owing money to First Gibraltar Bank, an institution they had never negotiated with and that possessed no institutional memory of informal understandings that might have existed before collapse. The transaction followed purchase and assumption mechanics, where the successor selected which assets and liabilities to assume. This distinction would become critical. Bradley and Gresset would claim Gibraltar had made additional funding commitments. Promises to advance more money for project completion. Oral agreements reached during workout negotiations. Understandings documented only in letter agreements that might not constitute binding contracts under traditional analysis. They would argue that Gibraltar's failure and subsequent asset transfer had disrupted funding arrangements they were counting on, making it impossible to meet payment obligations structured around assumptions of continued lender support. First Gibraltar Bank would deny any obligation beyond what written notes explicitly required. We purchased promissory notes, not unwritten promises. We assumed liability for documented debts, not alleged oral agreements. We are enforcing contracts as written. This stance, sometimes called the no-side deals principle in failed bank litigation, would prove devastating to borrowers who believed they had negotiated breathing room. The regulators who arrived at Gibraltar's offices brought file boxes, stamps, and signature authority. They conducted inventories. They reviewed loan files. They transferred ownership with paperwork that transformed relationships overnight. An institution that had been negotiating with Bradley and Gresset for months simply ceased to exist as negotiating partner. The successor had no institutional incentive to preserve relationships or accommodate development timelines. Its mandate was asset recovery. For Bradley and Gresset, the receivership created an awkward successor problem. They dealt with an entity that inherited Gibraltar's legal claims, but none of its contextual knowledge. New lawyers, new workout officers, new policies. The successor had purchased notes at discount, less than face value, which meant it could profit, even recovering less than full amount owed. This changed the economics of settlement. Gibraltar might have been motivated to restructure terms and keep the project alive. First, Gibraltar Bank might be better served forcing default, seizing collateral, and liquidating whatever could be sold quickly. The litigation played out in two venues with different outcomes. Bradley and Gressett initially fought foreclosure in state court, where they secured denials of summary judgment. The court found genuine factual disputes about what had been promised and whether the bank's conduct had been appropriate. Those denials kept the fight alive temporarily. But later, after the Federal Deposit Insurance Corporation intervened and removed the case to federal court, the trajectory shifted. Federal courts would grant summary judgment in favor of the successor bank and government, finding that written contracts controlled and no genuine disputes remained. The legal process, state court denials followed by federal summary judgment, would unfold over years. But the fundamental shift happened in 48 hours between December 27th and December 28th, 1988. A private negotiation between developer and lender became confrontation between debtor and government-backed successor, enforcing written terms with no memory of anything said outside signed documents. To defenders of banking regulation, the takeover brought order to chaos. Gibraltar had failed because of mismanagement and bad lending. The receiver's job was to protect taxpayers and enforce debts that irresponsible borrowers had incurred. Bradley and Gressett had signed notes. They had missed payments. The fact that their lender failed did not erase obligations. To critics examining the same timeline, the takeover weaponized paperwork rules to eliminate negotiation space. Development projects require flexibility. Responsible lenders and borrowers work through problems together. Gibraltar's failure and asset transfer converted what might have been a manageable workout into a winner-take-all legal battle where rules systematically favored the successor institution. The notes remained valid. The collateral remained pledged. The default remained pending. But now the conversation would happen under different rules, shaped by burn rate, funding arguments, and the mathematics of money running out faster than houses could sell. Chapter 6. Money Running Out. Burn rate determines survival. In May 1988, Bradley and Gressett missed a quarterly interest payment on the $15 million personal note. The payment was only a few $100,000, small compared with total debt, but the mistriggered consequences far exceeding the amount unpaid. Gibraltar declared default. Cross-default provisions in the loan documents meant the missed payment on one note operated as default on all notes. Suddenly, the entire capital stack, 4 project notes totaling nearly $80 million plus the $15 million personal note, became subject to acceleration. The lender could demand immediate repayment of everything. The missed payment reflected a fundamental mismatch between how quickly a master-planned community generates revenue and how quickly debt obligations come due. Subdivision development follows long timelines. Land must be purchased. Infrastructure must be installed. Utilities must be constructed. Roads must be paved. Only after groundwork can individual lots be sold. Even after lots sell, home construction takes months. Revenue arrives in lumps separated by long dry periods, while interest accrues daily and comes due quarterly. Court records describe Bradley and Gressett's continued efforts to obtain nearly $20 million in additional funding during the months after the missed payment. This was not money for expansion. It was capital needed to complete infrastructure already underway. to satisfy draw schedules for work in progress, and to make interest payments, keeping acceleration at bay. The search for additional funding consumed time and resources. Meetings with potential lenders, revised business plans, updated appraisals attempting to demonstrate that project collateral justified more exposure. Each meeting ended without commitment. Credit markets were tightening. Other developers faced similar problems. Lenders who had been eager in 1985 were cautious by 1988. Quarterly interest deadlines became countdown clocks. Every 90 days, another payment came due. Nearly $80 million advanced across project notes generated substantial quarterly obligations, even at favorable rates. The $15 million personal note, being unsecured, carried higher rates. Together, the interest expense created a burn rate requiring continuous capital infusions or continuous lot sales. The project had neither. Development projects demand continuous capital because infrastructure and amenities must be built before revenue arrives. A subdivision cannot sell lots without roads and water lines, and those roads and water lines cost millions to install. The developer must front costs using borrowed money, then recover the investment through lot sales over subsequent years. If sales slow, recovery extends. If interest rates are high or loan terms aggressive, the burden becomes unsustainable. The developer is caught between obligations that cannot be postponed, such as quarterly interest, contractor invoices, and utility district reimbursements, and revenues that cannot be accelerated beyond the pace at which buyers appear and qualify for mortgages. Paper crews worked as hard as field crews, though their labor looked different. Workout officers reviewed draw schedules. Collateral inspectors visited sites to verify that work described in draw requests had been completed. Lawyers drafted modifications, extensions, and forbearance agreements. Appraisers conducted valuations trying to determine whether the project's worth justified continued exposure. These professionals produced paper, not pipes. Meanwhile, the public infrastructure system continued operating on its own timeline. Municipal utility districts still needed pump stations and reservoirs. The city still needed water lines and wastewater capacity. Contract revenue bonds had been issued. Contractors had been hired. J.C. Evans and other firms kept crews working because public financing remained intact, even though the private lender was failing. The dirt didn't care about lawsuits. Trenches needed excavating. Pipe needed laying. Concrete needed pouring. Work continued because the district obligations were separate from Gibraltar's collapse. To observers focused on individual responsibility, the crisis represented mismanagement. Bradley and Gressett had overextended. They had borrowed too much. They had projected sales too optimistically. When reality fell short, they could not meet obligations. They were sophisticated business people who understood leverage. When leverage works, it multiplies gains. When it fails, it multiplies losses. The May payment miss was the moment multiplication turned negative. To observers watching the broader economy, this was macro credit cycle snap. The savings and loan industry was collapsing nationwide. Thrift institutions across Texas and the Southwest were failing. Lending standards that had seemed normal in 1985 looked reckless by 1988. Real estate markets were softening. Economic conditions that had made Circle C financing seem viable were evaporating. Bradley and Gressett were not uniquely incompetent. They were caught in a wave drowning hundreds of similar projects. The missed payment was symptom, not cause. Nearly 80 million already advanced. Nearly 20 million more sought unsuccessfully. Quarterly interest deadlines creating ticking clock. Sales pace insufficient to cover burn rate. Money was running out faster than houses could sell. The structure being built on public bonds would outlast the private financing that launched it. The May miss would lead to attempted workouts and side agreements that would themselves become contested terrain. Chapter 7. The Gray Zone. Workouts occupy territory between contract enforcement and relationship preservation. After the May 1988 missed payment, Gibraltar and the borrowers attempted restructuring. A workout agreement became effective September 1, 1988. The agreement likely modified payment schedules, provided temporary forbearance from foreclosure, established conditions for continued support. It represented formal framework for negotiations that would later become evidence in competing narratives about what had actually been promised. The parties exchanged 27 letter agreements according to the United States Solicitor General's brief filed years later in federal court. 27 separate written communications. Each letter attempted to capture understanding in words that would hold later. Some confirmed draw releases, others extended deadlines. Still others documented oral agreements reached during phone calls or meetings. The volume suggests constant negotiation, desperate attempts to keep a troubled project alive while protecting positions. Letters occupy ambiguous legal territory. Unlike formal loan modifications executed with ceremony-matching original notes, letter agreements might be viewed as preliminary understandings or temporary accommodations rather than binding contracts. Whether any particular letter constituted enforceable modification would depend on technical questions about consideration, authority, and contract formation that lawyers could debate for years. Alongside documented letters, Bradley and Gressett would later allege oral agreements for additional funding, verbal commitments made during negotiation sessions, phone conversations, promises from Gibraltar's workout officers about continued financing to complete infrastructure. The borrowers would claim reasonable reliance when making decisions about contractor commitments and draw schedules. They would argue Gibraltar's failure had disrupted legitimate funding arrangements. In 1989, the receiver advanced $5 million to the project. Court documents cite this example in connection with project needs. The borrowers could point to the advance as evidence the receiver recognized ongoing obligations. The receiver could point to the same $5 million as evidence of good faith. We helped, but we are not obligated indefinitely. Same transaction. Opposite conclusions. Conference tables surrounded by lawyers. Borrower counsel presented business plans and cash flow projections demonstrating viability. Receiver counsel reviewed collateral positions, demanding documentation for claimed commitments. Collateral inspectors reported on work completion and value. Appraisers conducted valuations determining whether continued lending made economic sense. Everyone worked from stacks of letters, draw schedules, earlier agreements, trying to construct shared understanding from documents never intended to be read in isolation. Then, appraisal shock. Updated collateral valuations revealed gaps between project debt and project worth. Real estate values had softened. The credit cycle had turned. What might have appraised sufficiently in 1985 now came in substantially lower. The collateral was underwater. If the lender foreclosed and liquidated immediately, recovery would fall far short of outstanding balance. This changed everything. A lender with adequate collateral might wait for conditions to improve. A lender facing guaranteed loss on liquidation had different incentives. The clash was fundamental. Commercial lenders and sophisticated borrowers negotiate constantly in normal times. Oral understandings happen. Handshake deals get confirmed in casual letters. Modifications occur through practices rather than formal amendments. This informal culture works when both parties have incentive to preserve relationships. Banks want to avoid losses from premature foreclosures. Borrowers want to preserve future credit access. Both sides benefit from accommodating short-term disruptions without legal process. Receivership law operates under different principles. The doctrine, traced to cases like Dwench, Do-Me, and later codified in federal banking statutes, holds that receivers and successor institutions cannot be bound by side deals not reflected in failed bank-written records. The rule protects against fraud. Without it, borrowers could claim failed banks had made unlimited, undocumented promises that receivers could not verify or refute. The successor institution inherits only what appears in proper written documentation maintained according to banking regulations. To defenders of the doctrine, this protects institutional integrity. Receivers manage public money and protect depositors. They cannot operate on claims of unwritten promises. They need documentation that can be audited, verified, defended in court. Without strict rules about what counts as binding commitment, every failed bank becomes a litigation nightmare where borrowers claim unlimited, undocumented obligations. To critics, the doctrine erases legitimate business relationships. The informal funding culture was not fraud. It was how sophisticated parties conducted business. Development is unpredictable. Construction schedules shift. Market conditions evolve. Formal amendments for every modification would be impossibly burdensome. Letter agreements and oral understandings allowed necessary flexibility. When Gibraltar failed, real relationships with real commitments existed. The doctrine didn't discover fraud. It declared legitimate commercial practices legally unenforceable after the fact. 27 letters, 5 million advanced, same workout agreement, same negotiation history, opposite conclusions about what had been promised and what could be enforced. Foreclosure was beginning. Cross-default made every dollar borrowed dependent on every other dollar staying current. Chapter 8. The Cliff. Cross-default transformed a single missed payment into total exposure. When Bradley and Gressett failed to make the May 1988 quarterly interest payment on the $15 million personal note, they did not simply default on that obligation. They defaulted on everything. Loan documents contained language binding all notes together. Default on any note constituted default on all notes. The personal note linked to 4 project notes. The project notes linked to each other. The entire capital structure functioned as a single interconnected system where one failure triggered systemic collapse. Visualize dominoes standing on edge. Each represents a separate note: land, amenities, Phase 1 development, Phase 2 development, the 15 million personal obligation. In normal circumstances, each operates independently with its own payment schedule and maturity date. Cross-default provisions connect the dominoes with invisible wire. Knock over one, and tension in the wire pulls down all others simultaneously. The missed payment in May was the finger flicking the first domino. Acceleration was the mechanism making cross-default devastating. Under normal circumstances, a promissory note establishes repayment schedule extending across years. Default on one payment typically entitles the lender to demand overdue amounts plus penalties. But acceleration clauses allow the lender to declare the entire remaining balance immediately due and payable. The borrower, who owed single quarterly interest payment, suddenly owes everything: principal, accrued interest, fees, penalties. The debt that was manageable when spread over years becomes impossible when demanded overnight. Cross-default plus acceleration created weapon of total control. The lender could choose whether to exercise acceleration rights. They could accept late payments and waive technical defaults. Or they could declare acceleration, making continued negotiation impossible because the borrower could never satisfy immediate demand for full balance. Missing one quarterly payment on the personal note gave First Gibraltar Bank the right to demand immediate payment of nearly $80 million across project notes, plus the $15 million personal obligation, plus all accrued interest and fees. No developer could write that check. Guarantees made the situation personally catastrophic. A guarantee is promised to pay someone else's debt if they cannot. Bradley and Gressett had each personally guaranteed 20% of Circle C Development Corporation's project notes. Even if the project entity defaulted, the lender could pursue Bradley personally for 20% of outstanding balance and Gressett for his 20%. Corporate limited liability, the shield normally protecting business owners from company debts, was pierced by voluntary guarantee signatures. Personal assets were exposed: homes, bank accounts, other investments. Everything could be reached by creditor seeking to satisfy guarantor obligations. The personal exposure created different pressures for each principal. Both faced ruin if the project collapsed completely. But individual financial positions and outside interests were not identical. Partnership dynamics strained when litigation strategy required unified defense, while personal risk was unequally distributed across different asset portfolios. Phone calls from lawyers, sleepless nights reviewing obligations, conversations with partners about who could access additional capital, who had family members willing to pledge collateral for emergency financing. The human cost of financial collapse plays out in conference rooms and private conversations, leaving no documentary record. The relationship between cross-default structure and funding dispute was direct. Bradley and Gressett needed additional capital to complete infrastructure, satisfy utility district obligations, generate lot sales covering debt service. They claimed Gibraltar had committed to continued funding based on workout agreements and letter commitments. If those funding commitments were enforceable, then lender failure to advance additional money was breach excusing borrower defaults. But if funding commitments were unenforceable oral promises or informal letters without contractual weight, then the borrowers had simply run out of money and defaulted on clear written obligations. To lenders, cross-default in complex development financing represents prudent risk management. Large projects involve multiple phases and separate note structures for administrative convenience. Without cross-default, a borrower could strategically default on one note while staying current on others, making unified action impossible. Cross-default ensures lenders can respond to any distress with total remedies rather than piecemeal collection. It protects lender rights where project components are legally separate but economically interrelated. To critics, cross-default was engineered control feature enabling lender takeover at first wobble. The structure was not designed for risk management, it was designed for asset seizure. By binding every dollar to every other dollar, the lender ensured minor disruptions became total defaults, triggering maximum leverage. A borrower struggling with cash flow but fundamentally viable could be forced into complete surrender because one missed payment activated acceleration rights across the entire capital stack. The clause converted temporary problems into permanent control transfers. Same contract language, same default sequence. Bradley and Gressett had signed notes containing cross-default provisions. They had missed a payment. The lender had declared default across all obligations. While the private finance war reached crisis, public battles over water and growth intensified around Circle C's political approvals. The project was not just about money. It was becoming a symbol in Austin's defining conflict. Chapter 9: The Water Fight. Circle C was never just a financial instrument. While Bradley and Gressett fought Gibraltar's successor in courtrooms over missed payments, another war was being waged in city council chambers and environmental advocacy offices. The fight was over water, growth, and who possessed power to shape the city's future. The Edwards Aquifer sat beneath southwest Travis County like a vast limestone sponge holding the region's water supply. Rainwater percolated through porous rock, filtering naturally before emerging at Barton Springs, the beloved swimming pool fed by constant 68-degree water flowing from the aquifer at millions of gallons per day. The springs were not just a recreational amenity, they were a symbol and watershed boundary marker. Anything built over recharge zones affected water quality downstream. Anything increasing impervious cover, roads, roofs, parking lots, reduced rainwater reaching the aquifer, and increased contaminated runoff during storms. Circle C was positioned directly over sensitive recharge zones. The development's 3,000-plus acres would be transformed from ranch land into streets, houses, commercial buildings. Every pipe installed, every road paved, every lawn fertilized would alter the relationship between surface and groundwater. Save Our Springs and allied environmental advocates organized to oppose not just Circle C, but the entire pattern of Southwest development threatening to industrialize the hill country and compromise the aquifer sustaining the region. The advocacy groups were not monolithic. They included neighborhood associations concerned about traffic, environmental scientists worried about ecosystem impacts, activists who saw growth politics as test of democratic accountability. They filed lawsuits challenging permit approvals. They testified at public hearings. They organized petition drives and ballot initiatives. They framed Circle C as a case study in how developers captured regulatory processes and pushed through projects benefiting private interests while imposing environmental costs on everyone downstream. City Council executive sessions became venue where power operated behind closed doors. Texas law allows councils to meet in executive session to discuss pending litigation without public observation. Circle C-related council meeting minutes include references to executive session agenda items, discussions of legal strategy, settlement negotiations, financial exposure occurring away from microphones and cameras. The public waited outside. Advocates could speak during open comment periods, but substantive decisions were shaped in conversations they could not hear. Silence was power. The public versus private framing created impossible complexity. Development approvals were public decisions made by elected officials accountable to voters. Infrastructure financing involved public bonds backed by taxpayer guarantees. Environmental permits required compliance with public regulations protecting shared resources. Yet the project was driven by private capital seeking private profit. The developers were not public servants. They were entrepreneurs taking personal financial risk to build something they believed the market wanted. The distinction between public and private became incoherent when billions in public infrastructure enabled developments generating private returns, when public environmental regulations were negotiated in private settlement talks, when elected officials made decisions about projects in closed sessions discussing litigation strategy. Water and wastewater capacity became political weapons because infrastructure approval functioned as development control. A city could block projects by refusing to extend water service or approve wastewater treatment capacity. Conversely, approving infrastructure commitments functioned as implicit permission for development to proceed, regardless of environmental concerns. The municipal utility districts issuing bonds to finance Circle C's pipes were exercising governmental power to enable private development. Withholding approval would have killed the project more effectively than any lawsuit. Legal settlements became policy by contract, mechanism where disputes resolved through negotiation produced outcomes functioning like legislation without going through normal democratic processes. When the city and Circle C's developers eventually reached settlement agreements, those agreements would include fee credits, development caps, regulatory frameworks extending decades. The terms would bind future councils and residents who had no voice in negotiations. Settlement, as policymaking avoided public debate about whether those policies served community interests or simply resolved litigation in ways both parties could accept. Environmental advocates defended public resources against private exploitation. The aquifer belonged to everyone. Barton Springs was shared treasure. Citizens had every right to challenge permits and use democratic processes to resist projects threatening collective well-being. Growth politics functioned as leverage. Environmental review became a tool for extracting concessions rather than stopping harmful projects. Litigation resolved through settlements, including fee credits and reduced density, arrangements allowing development to proceed while advocates claimed victory. The settlements converted litigation from existential threat into negotiating position. Barton Springs was ecologically significant. Circle C sat over recharge zones. Council met in executive session. Settlements included financial terms and development restrictions. The water fight would continue for decades. But in immediate crisis of 1990, private creditors were filing foreclosure actions and developers were scrambling for rescue that would not arrive. Chapter 10. When rescue fails. Foreclosure notices arrived with the inevitability of weather. In September 1990, First Gibraltar Bank filed suit in state court, seeking to foreclose on Circle C assets and collect on guarantees binding Bradley and Gressett personally. The legal papers enumerated defaults, acceleration demands, amounts owed. The filing transformed private negotiations over workout terms into public litigation where every claim would be preserved in court records. Within a month, Circle C Land Corporation responded by filing for Chapter 11 bankruptcy protection. The October 1990 filing was reported in local news as foreclosure defense maneuver, legal strategy to invoke automatic stay that bankruptcy provides, freezing creditor collection while the debtor attempts reorganization. Foreclosure actions would halt. Asset seizures would be postponed. The court would supervise negotiations between debtor and creditors. Foreclosure is the legal process by which lenders take possession of collateral pledged to secure debt. When borrowers default on mortgages or promissory notes, lenders file suit seeking court orders allowing seizure and sale of property. Sale proceeds go toward satisfying outstanding debt. If sale price exceeds debt, borrowers receive surplus. If sale price falls short, as it would in Circle C's case given the gap between debt and collateral value, lenders can pursue deficiency judgments against guarantors for remaining balance. Refinancing would have been the obvious escape if markets were functioning normally. Borrowers facing foreclosure from one lender could seek new financing from another, using new loans to pay off old debt and hopefully negotiating better terms. But 1990 was not normal time for Texas real estate finance. The savings and loan crisis had devastated regional lending capacity. Thrift institutions were failing across the Southwest. Surviving banks had tightened underwriting dramatically. Commercial real estate projects that would have attracted financing easily in 1985 could not find lenders at any price in 1990. The credit cycle that had financed Circle C's launch had snapped completely. Before the suit was filed, desperate attempts had been made to find external capital. According to reporting from May 1990, an outside investor had offered to purchase Circle C for $32 million or more. The offer represented potential exit, new capital that could have satisfied substantial portion of debt and potentially allowed the project to continue under new ownership. The offer was rejected. Why remains disputed. Perhaps the offer was insufficient to cover outstanding obligations. Perhaps it included conditions that Bradley and Gressett found unacceptable. Perhaps the bank preferred foreclosure to negotiated sale. The notices and deadlines consumed daily life. Interest payments due, extension requests filed, refinancing meetings scheduled with lenders who would ultimately decline, legal correspondence documenting positions for eventual litigation. The paper machinery of financial distress generated exhausting rhythm. Principals, who should have been focused on lot sales and infrastructure completion, spent days in lawyers' offices reviewing foreclosure defenses and bankruptcy options. The scramble occurred against background of allegations that would later surface in litigation and reporting. According to media accounts, questions were raised about how loan proceeds had been used. Funds allegedly diverted to buy out partner Mitchell Sharp. 423 acres allegedly diverted to an associate or partner rather than used for project purposes. Money allegedly used for unrelated personal obligations rather than infrastructure and development costs. Whether the allegations represented fraud, aggressive accounting, or routine development finance practices would be contested in court. They provided the lender with additional ammunition beyond simple payment, default. According to Wall Street Journal reporting from July 1991, Circle C had generated approximately $73 million in collections attributed to the project alone. The figure, which must be treated as journalism rather than verified accounting, suggested substantial revenue had flowed through the project even as default loomed. Where that money went would become central question in litigation. First Gibraltar Bank had purchased notes from a failed institution. The borrowers had missed payments. The bank's duty was to recover as much as possible for the Federal Insurance Fund. Foreclosure was appropriate enforcement of legal rights. Banks in 1990 were foreclosing on projects across Texas because the credit cycle had turned and lenders found foreclosure more profitable than workout. The successor institution had purchased notes at discount. It could profit even with partial recovery. Allegations about fund diversion might represent nothing more than how development finance worked when projects needed flexibility. The scramble was over. The suit was filed. Bankruptcy would become the new battlefield. Chapter 11. Rewriting Ownership. Bankruptcy became the mechanism for rewriting property rights that contracts could not resolve. The October 1990 filing by Circle C Land Corporation invoked Chapter 11 protection, the federal bankruptcy code provision allowing businesses to reorganize rather than liquidate. The filing triggered an automatic stay, freezing all creditor collection actions. First Gibraltar Bank could not foreclose. Contractors could not sue for unpaid invoices. Litigation stopped. The bankruptcy court would supervise negotiations determining who controlled what remained of Circle C. Chapter 11 exists to save viable businesses from premature destruction. Companies facing temporary financial distress propose reorganization plans, restructuring debts into something manageable. Creditors vote on whether to accept. If enough creditors agree and the court confirms the plan is fair, all parties are bound by new terms. Claims against the debtor are released as part of the confirmed plan, preventing creditors from pursuing litigation after reorganization completes. The bankruptcy courthouse hallways became a new venue for determining Circle C's fate. Negotiation rooms filled with lawyers representing competing interests. Bankruptcy counsel for the debtor argued for maximum breathing room to preserve operations and property values. Creditor committees demanded maximum recovery and control over asset disposition. Valuation experts fought over what the land was worth. Optimistic appraisals meant more value to preserve through reorganization. Pessimistic valuations meant liquidation might serve creditors better. Creditor hierarchy determined bargaining power. Secured creditors holding mortgages or liens on specific property got first priority. Unsecured creditors without specific collateral stood in line behind secured claims. Equity holders, the developers who owned Circle C's corporate entities, stood last, receiving nothing until all creditor claims were satisfied. First Gibraltar Bank held secured positions on major assets. The bank could veto any plan that did not adequately satisfy its claims. The reorganization proceeded through an entity called Circle C Development Joint Venture. The plan represented a negotiated resolution, converting disputed contract claims into new ownership arrangements. Tracts of land were mapped to different creditor recoveries. Certain phases went to certain parties. Conveyances transferred ownership from entities controlled by Bradley and Gressett to entities satisfying creditor claims. Plan confirmation required court approval and creditor acceptance. The bankruptcy judge reviewed whether the plan treated creditors fairly, whether it was feasible, and whether objections raised legitimate concerns. Once confirmed, the plan became binding. Claims covered by the plan were released. Creditors who had accepted could not later sue the debtor for amounts the plan addressed. These releases would matter years later when litigation resumed over issues the bankruptcy supposedly resolved. The land mapping was critical. Circle C was not a single indivisible asset. It consisted of hundreds or thousands of individual lots, parcels designated for different uses, infrastructure already installed or still incomplete, development rights subject to municipal approvals. Determining who got what involved forensic accounting to identify which creditors had claims against which specific properties, which parcels had enough value to satisfy particular claims, and which conveyances preserved enough development potential for reorganized entities to complete the project. The process played out between 1990 and 1992, according to secondary sources describing the bankruptcy timeline. The foreclosure suit was filed in September 1990. Bankruptcy followed within months. Reorganization negotiations extended across quarters and years, while lawyers argued over valuations, creditor priorities, and plan feasibility. Confirmation came approximately 2 years after filing, producing new ownership structures and claim releases supposed to close this chapter. Nearly $80 million advanced across 4 project notes according to court filings. $15 million on the personal note binding Bradley and Gressett as guarantors. Local reporting described total default magnitude reaching roughly $118 million when all claims and interest were tallied, figure encompassing amounts disputed in litigation rather than universally agreed accounting. Suit filed September 1990. Bankruptcy filing within months. Reorganization completing around 1992, based on available reporting. The bankruptcy process allowed rational negotiation, preserving what had been built while distributing losses among parties who had taken risks. The neighborhood would be completed. Creditors would receive recoveries. First Gibraltar Bank, the successor institution that had purchased notes at discount, used bankruptcy leverage to rewrite ownership on terms favorable to its recovery position. Developers who had taken personal financial risk lost control. The bank that had inherited notes through receivership got land and development rights. The bankruptcy supposedly resolved who owned what. Questions about what had been promised would move to federal court under rules strongly favoring the successor bank. Chapter 12. Show Me the Paper. The case that had begun in state court moved to federal jurisdiction where different rules applied. On August 18, 1993, the Federal Deposit Insurance Corporation intervened and removed the litigation to federal court under statutory authority granted to banking regulators. The removal was not merely procedural. It shifted the case from a venue where Bradley and Gressett had secured denials of summary judgment, suggesting genuine factual disputes requiring trial, to a venue where federal banking doctrines would control outcomes. The federal courtroom became the final battlefield. Legal teams filled the gallery. Borrower counsel presented stacks of letters documenting workout negotiations, arguing they evidenced binding commitments for continued funding. Receiver counsel demanded binding written contracts properly executed and maintained in bank records. The "show me the paper" motif defined every exchange. Claims about oral promises meant nothing without documentation meeting banking law standards. According to local reporting, the Federal Deposit Insurance Corporation's legal approach in the Circle C case drew from lessons learned in the Gressett litigation, a related case involving one of the principals. The Chronicle described how lawyers could use the earlier case as roadmap for pursuing claims against Bradley on similar debt structures. Institutional knowledge accumulated through previous failed bank litigation gave government lawyers strategic advantages that individual borrowers could not match. The Federal District Court granted summary judgment in favor of First Gibraltar Bank and the government agencies. Summary judgment means the court determined no genuine disputes of material fact remained requiring trial. The written contracts were clear. The alleged oral agreements and letter commitments did not constitute enforceable modifications under failed bank litigation doctrine. Bradley and Gressett had defaulted on documented obligations. Their defenses, based on claimed side deals, could not defeat the receiver's rights to enforce notes as written. Bradley and Gressett appealed to the United States Court of Appeals for the Fifth Circuit. The appellate panel consisted of 3 judges, Edith H. Jones, Jerry E. Smith, and Carl E. Stewart. On September 10, 1996, the Fifth Circuit issued an unpublished opinion affirming the district court's summary judgment. The appellate court agreed that undocumented side agreements could not defeat the successor institution's rights to enforce notes according to their written terms. The doctrinal principle was straightforward. Failed bank litigation operates under rules protecting receivers and successor institutions from claims based on unwritten promises. Banks maintain records of their transactions. When banks fail and receivers take over, receivers can only be bound by what appears in those official records. Oral agreements, informal letters, handshake understandings, even if they actually occurred, cannot be enforced against a receiver or successor unless properly documented in ways meeting banking law requirements. The rule exists to prevent fraud and fabricated defenses where borrowers claim failed banks made all manner of promises that cannot be verified. The state court had denied summary judgment, suggesting Bradley and Gressett raised genuine factual questions about what had been promised and whether the successor institution owned notes in ways giving it enforcement rights. Federal courts applying federal banking doctrines reached opposite conclusions. The contrast revealed how venue and applicable law determined outcomes more than underlying facts. To defenders of banking regulation, the rule protects the banking system from fabricated defenses. Without strict documentation requirements, every failed bank case would devolve into swearing matches about who promised what. Borrowers would claim unlimited unwritten commitments that receivers could not disprove. The rule protects integrity and ensures successor institutions can enforce debts without litigating every alleged oral understanding. But critics saw the rule erasing legitimate handshake culture and punishing borrowers unevenly. Commercial real estate operated through relationships where flexibility mattered more than formalism. Oral understandings and informal letters were how sophisticated parties actually did business. When Gibraltar was a functioning bank, both sides operated under these norms. But when the bank failed, the doctrine retroactively declared those norms unenforceable, not because they were fraudulent, but because they didn't meet documentation standards. The rule favored institutional creditor who purchased failed bank assets at discount while devastating individual guarantors. The litigation was over. The appeals were exhausted. The legal questions were answered. Circle C, the subdivision, continued operating. Houses were occupied. Streets were maintained. Municipal utility districts collected fees and made bond payments. The larger questions about how growth is financed and who bears risk when credit cycles turn remained unresolved. Life went on. The conflict moved into competing versions of what had happened and why, folklore that would be repeated with different emphases depending on who was telling the story. Chapter 13: Ordinary Suburb, Extraordinary Origins. The streets are finished. The houses are occupied. The litigation is archived in federal court files that few residents know exist. Circle C functions as normal Austin suburb. Families move in, children attend schools, homeowners mow lawns, and complain about property taxes. The massive financial structure that financed these streets collapsed years ago. The streets themselves remain. Pavement doesn't remember bankruptcy. Water flows through pipes that outlasted the promissory notes that paid for them. Construction left scars that persisted into routine operations. Community newsletters documented planned power service suspensions due to infrastructure work near major intersections. Residents received notices about temporary interruptions, mundane consequences of building a subdivision over environmentally sensitive land, while financial collapse proceeded in distant courtrooms. These disruptions were minor compared to battles over $80 million in defaulted debt. They affected daily life in ways the litigation never did. Power shifted from courtrooms to conference rooms. The Homeowners Association became the new venue for conflict. Associations govern subdivisions through covenants, private legal restrictions recorded against every property deed. Covenants function as mini-law for residents. They dictate paint colors, fence heights, parking rules, architectural changes. Violate covenants, and the association can fine, place liens on property, sue for enforcement. Residents elect directors to manage association business. Elections often involve tiny voter turnout and insider control. In 2003, Circle C residents filed suit against their homeowners association directors. The complaint alleged illegal assessments, ballot exclusion of certain homeowners, rule changes implemented without proper procedure. Judge Laura Livingston issued a temporary restraining order, emergency court intervention freezing association actions while the underlying dispute was litigated. Temporary restraining orders wield immediate power. A judge can halt actions, board meetings, elections, rule enforcement based on preliminary showings of likely harm. The order operates for limited duration, typically days or weeks, until a hearing determines whether longer injunctive relief is warranted. In neighborhood politics, even temporary court power shapes outcomes. Elections get postponed. Proposed rule changes are suspended. Directors who operated with assumed authority face judicial oversight. The suburban rituals continued beneath legal maneuvering. Homeowners attended association meetings clutching printed agendas and bylaws. Ballots arrived in mailboxes. Yard signs appeared supporting competing director candidates. Notices about covenant violations were posted on doors. These were mechanics of self-governance operating at subdivision scale, unrelated to federal banking doctrine or receivership law, but consuming equivalent emotional energy from participants. Homeowners organizing to challenge directors they believed exceeded authority. Elections deciding who controlled association finances and rule enforcement. Courts providing venue for residents without other recourse. Democracy functioning at local scale. Checking power through legal process when internal association procedures proved inadequate. But homeowners' associations were created by developers to manage property during construction. Initial directors were developer appointees. Control theoretically transferred to elected resident directors once enough homes sold. The governance framework, covenants, bylaws, architectural review committees, preserved structures benefiting original project designers. Residents inherited rules they had no voice in creating, enforced through quasi-governmental powers, privatized into association hands. The residents performing this civic labor were unpaid. They served on boards, attended meetings, reviewed architectural applications, organized elections, filed lawsuits on their own time using their own resources. This unpaid work maintained neighborhood order and property values benefiting everyone. It also perpetuated governance systems that few fully understood or had energy to reform. The labor was invisible to anyone not directly involved. Essential to subdivision function. The litigation eventually resolved. Directors changed. Elections proceeded. The association continued operating. But the underlying reality persisted. Streets built on collapsed capital structures, governed through covenants that outlasted the developers who wrote them, financed through systems still extracting payment decades after the original project sponsors lost control. The bonds remained outstanding. The reimbursement streams continued flowing. The fee credits accumulated value in municipal ledgers, tracking development rights granted years earlier through settlement agreements binding future councils and residents who never participated in negotiations. Chapter 14. The Money Never Stops. The litigation ended. The financial machinery continued operating. Municipal utility districts still collected fees. Bonds remained outstanding. A complex system of reimbursements and development credits continued generating value years after the original developers lost control. The money trail had an afterlife independent of who won in court. The reimbursement mechanism worked simply. Developers built water and wastewater facilities using private capital. Once completed, they conveyed ownership to the district. The district issued bonds and used proceeds to reimburse developers for construction costs. The developer's reimbursement right, the contractual claim to future bond proceeds, functioned as a financial asset that could be sold, pledged as collateral, or fought over in litigation. Reimbursement rights became subjects of their own legal battles. Phoenix Holdings Limited sued Circle C Land Corporation in dispute centered on who owned certain reimbursement rights. The Texas Appellate Court addressed the question in a published opinion at 987 Southwestern 2nd, 933. The case demonstrated that even after main foreclosure and bankruptcy battles resolved, subsidiary fights over development rights and payment streams could generate years of additional litigation. The reimbursement was worth fighting for. Lenders fought over reimbursement streams because they functioned as collateral. Banks making construction loans could take security interests in developer rights to future district reimbursements. If developers defaulted, Lenders could step into reimbursement position and collect directly from districts. The reimbursement stream converted illiquid construction work into revenue-generating asset that financial institutions understood how to value and trade. It was how private capital recovered investment in public infrastructure. In 2002, a development agreement settlement restructured Circle C's relationship with the city of Austin. The agreement established municipal regulations extending through 2032, 30 years of predetermined development rules, insulating the project from future political shifts. It also created $15 million in FEE credits that developers could use to offset city impact fees on future construction. FEE credits functioned as currency within municipal development systems, transferable economic value that could be sold to other developers or deployed to reduce costs on Circle C's remaining phases. The credits came with restrictions. According to later corporate reporting, Circle C could sell up to $1,500,000 worth of credits per year. The sale cap prevented market flooding while ensuring credits retained value over long time frame needed to fully utilize $15 million. The 2002 settlement vote generated protest theater at City Council. Citizens opposed to continued Circle C development wore kerchiefs over their mouths. The symbolism was clear. They believed they could not speak, that public input was theater while real decisions happened elsewhere. Chants echoed through council chambers. Residents felt silenced by processes producing predetermined outcomes regardless of testimony. The water bill war framed reimbursements as proxy battles for development control. Whoever controlled reimbursement rights controlled incentives for infrastructure expansion. Whoever controlled fee credits controlled future development capacity. The technical financial arrangements were actually political questions about who decided growth trajectories. Small violations occurred invisibly. City watershed spill logs recorded illegal dumping incident at Slaughter Creek, someone emptying wastewater from vehicle on bridge over the creek. The entry documented business name and phone number. Minor infraction measured against multi-million-dollar bond issues, but it represented the same dynamic: private actions imposing public environmental costs. What flowed into Slaughter Creek eventually reached the aquifer that the entire fight was supposedly about protecting. After years of litigation, all parties accepted terms allowing development to proceed under clear constraints. The 30-year regulatory framework provided certainty for developers while locking in environmental protections. Fee credits compensated for earlier disputes without requiring cash payments. $15 million in fee credits represented foregone city revenue, impact fees that future development would not pay. The public system absorbed cost, while private entities captured benefit. The 30-year regulatory certainty protected developers from democratic accountability. Future councils and residents were bound by agreements negotiated during crisis. $3,300,000 in early bonds, $38 million refunding authorization, $15 million in fee credits, $1,500,000 annual sale capacity, regulations through 2032. Each number represented obligation or opportunity that would outlast everyone involved in creating it. The machinery kept operating. The competing stories about what it all meant continued evolving into legends serving different purposes for different audiences. Chapter 15, Stories We Tell. The same events generate different legends depending on who survived to tell the story. 20 years after litigation ended, Circle C meant different things to different audiences. The facts remained constant: the notes, the defaults, the receivership, the bankruptcy, the federal rulings. But meaning extracted from those facts diverged completely based on whose perspective was adopted and what lessons were wanted. Developer folklore split into opposing narratives. One version cast Bradley as villain, reckless leveraged speculator who overextended, diverted funds, then attempted escape through legal technicalities when gambles failed. The foreclosure and court rulings represented justice, catching someone who had lived beyond means. The other version cast Bradley as martyr, visionary builder, destroyed by credit cycle snap and weaponized banking doctrine that retroactively declared normal business practices illegal. The receivership erased legitimate commitments. Regulator folklore divided similarly. The system stability narrative framed government intervention as heroic, receivers and successor institutions protecting taxpayers and depositors from failed bank losses while enforcing contracts fairly. Without strict documentation rules, every failed bank would generate unlimited fraudulent claims. The opposing narrative saw regulators weaponizing paperwork requirements to eliminate negotiation space. The doctrine did not prevent fraud, it retroactively criminalized handshake culture that both sides had operated under when convenient. Environmental advocates told competing watershed stories. The salvation narrative celebrated citizen resistance, preventing aquifer destruction. Circle C was stopped from building without adequate environmental review. Litigation forced settlements protecting Barton Springs. Activism worked. The counter-narrative emphasized housing scarcity and growth backlash. Wealthy environmentalists blocked affordable housing while driving prices higher. The aquifer survived, but working families couldn't afford homes. Residents who moved to Circle C after litigation ended occupied different narrative space entirely. They inherited finished streets, functioning utilities, homeowners association rules without choosing any of it. Their folklore centered on innocence. We bought houses in normal subdivision. We did not participate in financing war. Why are we still dealing with its consequences? They governed associations managing infrastructure financed through bonds extending decades. They paid fees covering reimbursements negotiated when they were children. The castle, the turreted building at 1111 West 11th, where Bradley kept offices, functioned as both myth and material place. Some saw mansion built on borrowed money. Others saw ordinary professional space demonized through association. Named judges became institutional faces attached to doctrine. Edith H. Jones, Jerry E. Smith, Carl E. Stewart, the Fifth Circuit panel that affirmed summary judgment. Laura Livingston, the judge who issued Homeowners Association restraining order years later. These names appeared in legal databases and local reporting, becoming shorthand for particular outcomes. Named contractors represented invisible backbone. J.C. Evans Construction, Hayden Concrete, Triple Vi Construction, Robert Hurst Company. These firms built the actual pipes and reservoirs, while financial and legal battles proceeded around them. Their workers' names were never recorded. The companies got occasional mention in council minutes. Present at creation, absent from legend. Myths formed through predictable processes. Selective memory preserved dramatic moments while forgetting mundane details. Documents disappeared into archives nobody consulted. Participants had incentives to simplify. Borrowers emphasized lender misconduct. Lenders emphasized borrower default. Advocates emphasized environmental victory. Developers emphasized regulatory burden. Each simplified version served narrative purposes more effectively than complex truth. The temptation was to choose sides, to declare one legend true and others false, to identify villains and heroes, to teach clean moral lessons. But the documentary record resisted that simplicity. Multiple people made rational decisions based on available information and legitimate incentives. Structural forces shaped outcomes more than individual virtue. Shared blind spots afflicted everyone. Borrowers who assumed credit access would continue, lenders who assumed real estate values would hold, Advocates who assumed blocking development solved housing problems. Regulators who assumed doctrine protected fairness. The legends would continue evolving. New residents would inherit old disputes without understanding origins. The financial machinery would keep operating decades after participants died. The fundamental questions about growth, debt, public subsidy, environmental protection, who bears risk when systems fail, would remain unresolved. What remains is not legend. It is infrastructure, obligation, and the pump station still humming at dawn. Chapter 16. What outlasts? The pump station hums at dawn. Water moves through pipes that outlived the banks, the developers, the litigation. Grackles perch on chain link. A crew arrives, routine inspection, checking seals and gauges. The subdivision wakes. Traffic builds toward highway ramps. Nobody thinks about promissory notes. Circle C exists as ordinary suburb. 3,700 homes house 11,000 residents. Streets wind through neighborhoods where families bought houses without learning what financed the pavement beneath their driveways. The Lady Bird Johnson Wildflower Center occupies 500 preserved acres, native plants, and walking trails on land that once secured $80 million in defaulted debt. Retail strips, weekend soccer games, coffee shops with parking lots. Paper determines outcomes invisibly. Homeowners Association covenants recorded in the 1980s dictate what residents can build, plant, or paint on properties they purchased decades later. The 2002 settlement binds city council decisions through 2032, regardless of which citizens elect which representatives across 3 more election cycles. Municipal utility district bond schedules determine fees that young families budget around when calculating whether they can afford to stay. Reimbursement obligations flow from contracts signed before most current homeowners graduated high school. Rules written by people residents never met. Maintenance work continues unseen until something breaks. Utility crews clear sewer lines and inspect pump stations on schedules determined by engineering standards and bond covenants. Contractors resurface roads damaged by tree roots and weather. City inspectors verify water quality meets state standards. The district board, volunteers mostly, reviews budgets during evening meetings attended by perhaps 12 people. One pump fails, and suddenly everyone discovers the invisible labor sustaining normalcy. Most families moved here for schools and commute times. They toured model homes, secured mortgages through banks that asked no questions about receivership doctrine, hired movers. Welcome packets arrived from Homeowners Association containing architectural review guidelines and assessment schedules. The packets said nothing about Fifth Circuit opinions or cross-default clauses. Real estate agents praised neighborhood amenities without mentioning Gibraltar Savings Association. Mortgage brokers processed paperwork without explaining how public bonds financed private development. Governance notices arrive monthly. District board meetings to discuss bond refinancing, association elections where competing slates argue about assessment increases and covenant enforcement, environmental advocates monitoring development permits to verify compliance with watershed protections negotiated during crisis years. Administrative machinery created during financial collapse persists as routine paperwork that residents file without reading. The pattern repeats across growing cities. A story of private capital financing construction. A story of public bonds enabling value creation. A story of credit cycles turning and private losses becoming public obligations. Developers capture upside through property sales. Ratepayers absorb downside through fees outlasting original project sponsors. Who pays when development finance collapses never gets resolved. The question gets restructured into arrangements where the answer becomes invisible. To families living here, Circle C represents successful suburban planning, good schools, safe streets, reasonable commute. To developers who survived litigation, it represents property rights secured through decades of legal maneuvering. To environmental advocates, it represents growth constrained by activism and settlement. To financial analysts examining municipal balance sheets, it represents public infrastructure that enables private profit while taxpayers guarantee bonds. All of this is true simultaneously. Landscape crews arrive, traffic signal maintenance trucks follow. Workers whose names nobody knows perform labor that residents notice only through its absence. Streets stay paved, pumps keep running. Water flows through treatment systems that cost tens of millions to build and millions each year to operate. The ranch became a subdivision, became a balance sheet, became a functioning neighborhood where children grow up unaware of its origins. 3 decades after litigation ended, debt instruments creating this place have been satisfied, refinanced, or written off. The obligations they established persist. The pump station will require replacement within 15 years. Bonds mature on schedules extending into the 2030s. Fee credits authorized in 2002 create development capacity through 2032 that future councils inherit as constraint rather than choice. The infrastructure is permanent. The obligations are permanent. Only the names change. Morning sunlight hits the pump station fence. Grackles scatter and return. Water moves through pipes that remember nothing but function regardless. Somewhere in Federal Courthouse Archive, boxes contain the legal record. Nearly $80 million advanced across 4 project notes. $15 million personal guarantee signed by Bradley and Gressett. 500 acres preserved at the Wildflower Center. 3,700 homes built. 15 million in fee credits authorized in 2002, deployable at 1,500,000 per year through 2032, bonds maturing on schedules extending into the 2030s, 30 years of predetermined regulatory frameworks binding future councils. Nobody here will read those files. They live with consequences daily.